Hey everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're going to be discussing a couple key elements of the market. We're going to be discussing the big six mega caps, Apple, NVIDIA, Microsoft, Google, Amazon, and Meta, and discussing their relative performance compared to the overall S&P 500. We're also going to touch base on natural gas in this video, oil, and then what is transpiring in the overall gold market as well. So lots of key points to discuss, but I think touching base on all aspects of those markets will give us a brief outlook of what is likely going to transpire in the near term. So looking at this chart, I've combined Apple, NVIDIA, Microsoft, Google, Amazon, and Meta in one single chart. Basically, the price action of these six large mega cap companies have been outperforming the broad market. So you can clearly see that there's actually this beautiful inverse head and shoulders that is playing out for the mega cap companies. And you can see that it's actually broken to the upside, and you have had a beautiful rally right into a magnificent resistance point. You've rallied up over 11% from that initial breakout neckline. Now, the importance of this level is this market needs to consolidate. These large companies have pulled the S&P out of the deep depths, darks of the low, and have really been the relative strength and breadth that has kept this market up. So overall, the breadth in the market has clearly lagged these particular mega cap companies. So if you had to remove them, the S&P would actually be much lower. To put things into perspective, I've drawn the S&P out here as correlation. The S&P, notice how it's forming this same pattern here, your inverse head and shoulders, and this is a weekly chart, so every candle represents 1 week of data. The S&P has that very similar neckline down sloping here in white, and you can see it's breaking above, trying to break out. Now, the importance of this is that the big six mega cap companies have had a massive divergence. They've rallied up over 11% at the highs, and the S&P is up just a little bit, about 1% from this breakout zone. So you have to wonder and ask yourself, is the market likely to continue its trajectory to the upside if these stocks are stuck at resistance? Ultimately, the S&P will not make a meaningful move to the upside if these stocks don't continue their trajectory to the upside. So what I'm getting at is that the mega cap companies, these six stocks that have lifted this market higher in the recent month or two, are stuck at resistance now. They're at the 50% retrace. If you take this high to this low, it's an exact 50% retrace of this downward bear market move. And you're in an extended state. You've had 1, 2, 3, 4, 5 weeks of green candles in a row, and you're retracing to an important breakdown zone. This is arguably what they call the neckline of this breakdown zone, where you had a sharp move down, a retrace failure, another retrace, bigger failure, and now you've retraced back to that zone where you broke down over here and had a hard reversal in these mega caps. Now, the upside target for this pattern does take you, believe it or not, to about 1391 for the mega caps, so it's still implying a great deal amount of upside. But the thing about this pattern is it doesn't get there in a straight shot. It needs to back and fill. There needs to be lots of choppiness. There needs to shake out weak hands. And ultimately, this should retrace back to the breakout zone at some point. So if you factor in that it's likely that these mega cap companies are to retrace back to the breakout zone, and believe it or not, even if it fell back to that breakout zone, this would still be technically bullish. It wouldn't mean that the bull market is over, this potential breakout, but it will mean that the S&P is likely to fall back below this neckline and trend a little bit lower. And that's where the things get dicey and really tricky, is that these mega caps have really skewed the market movement in so favor of a very handful of few stocks that if these companies show any sort of weakness, it's going to drag this market down. This divergence is likely to cause the mega caps to fall, which is likely to create a bigger move down in the S&P 500. You're not going to see the S&P rallying up and closing the divergence if these stocks aren't also trending much higher. So just be very careful about chasing this potential rally. Know that the mega caps have seen most of the money flow. Identify that these stocks are at resistance and are extended, not saying they're going to fall, but they need ample consolidation. You're going into massive resistance zone in an extended move, and you need to see consolidation in these key names. And one other aspect of the market, if we look at the NASDAQ QQQ, so Let me just erase all that. Let me pull that. The NASDAQ on the daily chart had a massive move today, arguably breaking out of this little wedge pattern. So yesterday we had a big down move, and today it was followed by a gap up and a power bar to the upside. Now this isn't a bullish engulfing candle because you gapped up, so it does favor eventually a pullback to fill that gap. The thing about the NASDAQ is a couple things we have to take into account here. The NASDAQ is obviously tech heavy, QQQ specifically. I'm concerned about what transpired today. So you had the NASDAQ up over 2%, a magnificent rally, and then you look at NVIDIA. So let me just pull up that chart, NVDA, and let's start fresh on NVIDIA. Remove all these drawings. NVIDIA is actually on the verge of triggering this topping formation. If you look on a larger term time frame, let's do the 2-hour chart because that shows the pattern pretty nicely. You can see here NVIDIA has broken 2 key trend lines. Here you have a perfect neckline where NVIDIA tried recapturing and got rejected, recapturing again, got rejected, and then finally rejected. So you've triggered this little topping formation on NVIDIA. You also have this little upsloping neckline, which is just a little bit of a steeper incline from that little pivot there. But needless to say, it finally looks like the trend on NVIDIA is breaking lower. And this is the thing, is that NVIDIA actually closed negative today, just slightly down minus 0.12%. But the QQQ finished up just about 2% on the session. So that is a huge negative divergence for NVIDIA. The fact that NVIDIA couldn't get money flow into it when the Qs were up over 2% is just mind-blowingly shocking. And that's very rare to see that, especially when you factor in how strong NVIDIA truly has been in the overall trend of things. So right now on the daily chart, NVIDIA is looking a little bit more vulnerable to more downside. So we'll just have to pay attention to what aspect of this starts to roll over. And again, if we see any weakness in the Qs, this will likely be a relative weakness play. And I mean, at the end of the day, NVIDIA is extended. Let's just simply go to the weekly chart. I mean, you've had basically little to no consolidation. You're into this massive resistance zone. Look at this. This is where you had a potential breakout which failed. Those sellers that got trapped in there on the breakout will be selling. And that's what I think you're seeing right now. And again, this is a massive, powerful move. I mean, if you were an NVIDIA bull and caught the low, I was amazed because I was buying NVIDIA down here, but I sold it way too prematurely. I mean, I didn't catch any of this move, so to speak. But needless to say, there's a lot of other opportunities in the market. But this is extended. You're basically where you should retrace to. And where's the big level for the NVIDIA bulls? This wide range weekly this pivot over here. This pivot sitting at around 223 is going to be the level for the NVIDIA bulls. If you lose that on a weekly close, you're likely going to test this 187 zone. As of now, this is just a simple pullback. It needs a correction. If NVIDIA plans to go higher, it does need a meaningful correction, both technically and fundamentally speaking from its evaluation. Now let's jump onto the energy markets, shall we? So let me just flip to this other chart here. That's the XLY. But let's touch base on natural gas. So natural gas got pummeled again today, down. What else is new? We've been very this choppy price. This action in natural gas is so choppy. I mean, we've been calling a breakout. We got the breakout. Now you're doing a full-on retest of the breakout, and there's just so many sellers lurking in this natural gas chart that it's actually amazingly wicked. Now, the fact of the matter is that you're still holding this impulse green candle to the upside. You've done a full retrace, 2 hard days of selling, and you weren't able to close below that. You're still also holding this major pivot zone on a weekly basis and on a monthly basis. But that's not a strong reversal on a weekly basis. When you get that type of price action, specifically after a hard down move, it just shows you how weak this price action of natural gas is. But the inventories came in line with market expectations, and the price action still sold off. Now there is a little bit of a positive intraday. Let's go to the other natural gas chart, because I do have that up, capital.com. You did get a little bit of an hourly reversal on natural gas at the late in the hourly session here, which had another sharp down move. Never really closed below because you closed inside of this wick, you still closed inside of that wick. And then you got a heavy volume reversal, made a new low in the trend, but reversed with an engulfing hourly on the intraday chart. So short term positive being the fact that there was accumulation. The only thing that scares me is this little technical gap down here. Actually, you know what? You pretty much filled that technical gap, so I'm going to say that is filled right now. So no longer am I worried about that gap. That has actually been technically filled, so I changed my thesis. And short-term positive, this actually looks like it could try to build a base higher, even with the big down move. Obviously, position management is key because this isn't an easy trade. This is a longer-term time frame pattern. It's not going to be instant gratification like this move over here. Let the chart load. This was a powerful move. I mean, this was unsustainable. The fact that natural gas moved this fast made it really unsustainable, and this is why you're getting a larger correction. But ultimately, I do think in a year or two time, and likely even sooner, we should see natural gas making a move to the upside. It's really been trading in lockstep with the US dollar. For all you natural gas bulls out there, you should be really paying attention to the dollar because natural gas downsloping wedge pattern has basically been mimicking the United States DXY chart. And once the US dollar starts going again, I think that's when we're going to see a move in natural gas. Really, these patterns are very similar. Again, you have your downsloping wedge over here, which you did technically break out of, and you're just doing your simple retrace. Now, could you fall all the way back down to this downsloping wedge? You absolutely could get a retrace down to that level again, and that would still mean you've technically broken out of the wedge pattern. The big thing is obviously on the weekly chart, not closing below this pivot, and also on a monthly basis, not closing below this pivot. And then obviously, you don't really want to lose this downsloping wedge pattern and closing below that. So there's kind of like three factors there that I'm looking at for the natural gas chart. But again, these are the levels that you have to take shots at. The world needs natural gas. The natural gas usage is really only going to increase if we really factor in where the green electrification energy movement is. It's still a long ways off. I mean, you still have ample usage from the industrial side, from the residential side of natural gas, and it's ultimately here to stay because it is definitely one of the more efficient uses of energy. On that note, let's just see if there's anything else I want to touch base on. I think we've covered quite a decent amount in this video, so I am going to leave you on that note. It was interesting to see the Dow Transports down today in such a rip-roaring market. So they say the Dow Transports is the barometer of the economy in a way, and ultimately when the markets are trending up, when you have a rip-roaring rally on the Spiders, the Qs, and the Russell, but the Dow finishes down, you know, that's not healthy for the economy. And look at this simple trend line that we're watching. Basically, you triggered this head and shoulders. The downside target on that is about a, let me just see here, let me just draw this in. You're talking about a move down to still down here around 12.5 on the Dow Transports. So lots of weakness still in the transports. Obviously, airlines were under pressure with the price of oil, with some bad earnings. They did have, some of them did have a little bit of a bounce back, some reversed lower. We did get some notice after the bell that Boeing got hit, something to do with one of their big jets. They're no longer producing, or there's an issue. Sorry, there's an issue with one of their jets, but I don't really know what that issue yet is, but definitely the stock and market participants didn't like Boeing. For Boeing to be down about 4% in the after hours, that's a big drop for Boeing. And Boeing, again, is a Dow component, so that should weigh in on the Dow. Boeing is in the Dow, and notice how the Dow is right at resistance. Look at this, downsloping trend line, major component of the Dow just gets all of a sudden harsh news, and it basically is going to likely cause the Dow to drop, unless all of the other stocks in the Dow start to really outperform. But even when you look at some of the other Dow components, like United Health, I mean, just a parabolic move. Another short setup that I'm looking at with my members, Eli Lilly, LLY, look at this parabolic move. I mean, that's not a healthy move. That's unsustainable, and it's people chasing. Lots of exuberance. Yes, it's a safe company, but again, when you have a move like that, that is crazy extended, and it will need consolidation. Stocks just don't typically go up like this. This is almost like a meme company stock, when in reality it's a mega cap company in the healthcare sector. But you're at double top. I would like to see it pierce, maybe have a 3-bar surge to a blow off. If you get another gap up or surge to a high here, Eli Lilly becomes a good short candidate for a day trade opportunity. If you can able to pick the high in a day trade scenario, and for a little bit of a swing trade pullback. I think Eli Lilly should actually pull back. This is actually going to be a weekly chart pattern. So I think Eli Lilly will actually pull back at least to about 362, maybe even 355, somewhere in the midpoint of this bar. But definitely a powerful move in a lot of these healthcare sector stocks as money rotates defensively. And again, even with the broad rally today, one sector that was down, real estate. XLRE did not perform as well as it should. And again, this is ahead of a lot of the banks reporting earnings in the tomorrow, and as we head into the remainder of the bank earnings season next week, you have a lot of commercial real estate exposure. Names like VTR. You know, that one's under pressure, which, full disclosure, I am short that name. Alexandria Real Estate, ARE, also under a lot of pressure today. Some of the home builders were under pressure early on, but managed to have squeak. Actually, ITB did finish down slightly, even in the strong tape. You did have Lennar, I believe, also finished down. Look at that. Home builders getting rocked in a market with absolute undeniable strength. So it really shows you where the overall amount of capital was rotating into in this overall market rally today. And it was very, very clear and evident to me that the mega caps just keep getting bigger and more bloated. On that note, I hope this video helps and provides you a little bit of insights into what the market environment is shaping up to be, some potential trade opportunities in the near future, and I wish everyone well. This has definitely been a choppy market, not easy for investors, not even easy for traders, but just be staying nimble and taking it day by day, as the market is so dependent on the data, is key to basically surviving and thriving in this market. On that note, take care everybody, and we'll see you on the charts some other time.